Good morning, everyone. Welcome to my channel Conceptualize, and today I'm going to clear your concepts on the capital asset pricing model. So CAPM, or the capital asset pricing model, it basically is defined as a financial or a mathematical model that shows the correlation between the risk that is associated with a security and the return an investor is expected to or is guaranteed to receive by investing in that security. You see, whenever someone is making an investment decision, there are two basic things, two most important things that they take into consideration. First of all, how much risk is associated with that investment? How much risk, what level of risk is that investor going to bear by investing in a specific security or making a specific investment decision? Secondly, how much returns is that investor expected to or is guaranteed to receive by making that specific investment decision or investing in a specific security? Now, different investors make different investment decisions depending upon their own nature or the economic conditions, financial conditions, or market conditions of their country. First of all, we will discuss this risk-averse investor. Now, a risk-averse investor basically is someone who prefers safety in their investment decisions, who prefers safety in their investment over taking too much or unnecessary levels of risk. It basically means that they want constant or guaranteed returns over their investment with little to almost zero levels of risk. So for such investors, the best option the best place where they can invest their money is that they can either deposit their money in a savings account in the bank or they can buy treasury bills. Now, why bank is a good option for such risk-averse investors? Bank, it actually is a good option for them is that when you deposit your money in a savings account in the bank, it basically has a fixed interest rate or a fixed rate of return with little to almost zero levels of risk. Why? Because it is backed by the government. Now, if the risk level is almost zero and you are getting a fixed rate of return, a fixed amount over your investment. So can I call this rate of return or the amount that the bank will pay me over my investment, can I call that a risk-free rate of return? Of course I can. Why? Because I'm not taking any risk over here. Whereas the amount, the rate of return, the returns I'm getting over my investment, it will remain constant. So this rate of return that the government pays you when you deposit your money in a savings account in the bank or when you buy treasury bills, etc. So it basically is the risk-free rate of return. Then we have the second type of investors whom we call the risk takers. Now, the risk takers are basically those who want greater returns over their investment by accepting a certain level of risk. Let us understand it like this. If I tell you to invest in the stock market instead of depositing your money in the bank, and I will give you a 7% expected rate of return. Note it down, expected rate of return, not guaranteed rate of return. Will you accept my offer? Of course not. Why? Because for zero level of risk, for zero risk, I was getting 7% returns, 7% guaranteed returns when I deposited my money in the bank. Now, if I'm going to invest in the stock market and I have to accept a certain level of risk, then I want greater returns. I won't just accept only 7%. So, in order for you to accept my offer, I will make it a bit more fruitful, a bit more acceptable. All right, how about 8%? Will you still accept my offer? Of course not. Why? Because the risk is greater as compared to the returns I'm getting. Finally, we will both reach to a point where you and me will both accept the offer, and I will tell you that I'm going to give you 16% returns if you invest in the stock market. You will accept this offer because 16% is reasonable enough. Now, I'm getting 16% returns for accepting a certain level of risk. Let us consider that the risk over here is one index. So, in this 16% returns, in this 16% rate of return, if we deduct the 7%, we will get a 9%. Now, why am I deducting the 7% over here? It is because that this 7% is already there. This 7% I can easily get by for zero risk by depositing my money in the bank. Now, this 9% that I get over here, when I deduct the 7% from the 16%, it basically is the risk premium. What it means, this 9% is the additional return. It is the additional amount that I will be getting for accepting a certain level of risk. It is the additional or the premium amount that I'm getting for investing in the stock market for accepting a certain level of risk. Add it up and we get 16% returns for investing in the stock market. Now, if I tell you that instead of investing in the stock market, why don't you buy the shares of a specific company? Why don't you invest in the securities of a specific company? You will tell me, okay, but as you see, the risk over here is greater as compared to the risk that I had to bear by investing in the stock market. So I want greater returns as compared to the returns I was getting by investing in the stock market. You see, by moving from 0 to 1, you got 9% additional returns. Now, if you are moving from 1 to 1.4, as you are investing in this security in the shares of a specific company, so of course the risk over here is going to be greater. So, how much returns do you require? What is your required rate of return? How much return should I pay you if you are going to accept this level of risk?
Now we can find the required rate of return like this.
You see, for a risk of 0, I'm getting 7% returns. When the risk in the investment increased and it moved from 0 to 1, I'm getting a greater return over my investment, that is 16%. Now, if the risk continues to increase and it moves from 1 to 1.4, I want additional returns. I want greater returns over my investment. See, 0 to 1 and I've got a 9% risk premium. Now, if I'm moving from 1 to 1.4, I want a greater risk premium. How are we going to find that? Easily through this formula. For a risk of 1, I'm getting 9% premium. For a risk of 1.4, how much risk premium do I require? How much additional returns do I require? Easily, X equals to 9 into 1.4 and I get a risk premium of 12.6%. Now this 12.6% over here, it is the risk premium or the additional returns I will be getting for buying the securities of a specific company, for investing in the shares, for investing in the securities of a specific company. That is, adding this 12.6% with the risk-free rate of return, I get 19.6%. Now, this 19.6% is the required rate of return that I require for investing in the stocks, for investing in the shares, for buying the securities of a specific company. Now we will see whether the rate of return that we got, that is 19.6%, whether it is correct or not. So the required rate of return that we found earlier was 19.6%. Let us check it out through the actual formula of CAPM. This, my friends, right over here is the formula of CAPM, formula of capital asset pricing model, which is like this. Required rate of return equals to risk-free rate of return plus beta. Beta refers to the risk that you have to bear for investing in the stocks of a specific company. I will explain it to you in detail in the upcoming video. Multiply by market, the rate of return that you get for investing in the market minus risk-free rate of return. Risk-free rate of return is 7% plus beta, we have 1.4 multiply by 16% rate of return that I get for investing in the market minus 7%. Solve it out and you get 19.6%. So the required rate of return is 19.6%. This is the rate of return that you require or I require for investing in the stocks of a specific company. I hope you all got my point. This was all about CAPM. Thank you for listening. Have a great day ahead.